Welcome back to the Strong Wealth Podcast. I'm excited for this one today. My guest is Mitch. Yes, we're both named Mitch, but this is Mitch from Blockware Solutions. We're going to be diving into the economics of Bitcoin mining in detail. Transparently, I don't know a ton about the profitability of mining, what the variables are that drive it, how it actually works. I lean heavily on my business partner, Jacob, for that. And, I'm going to be approaching this as a somewhat newbie, if you will. So if you're someone that's looking to learn more about Bitcoin mining and understand where it might be able to fit in your financial plan, how it might be able to benefit you, from just earning more Bitcoin at a discount, or the tax benefits, of course, which we won't go into today. But I want to understand, if I put money into this thing and I get the tax benefits, what's my actual investment going to look like? And so that's what's going to drive this conversation. So let's just start there, Mitch. I mean, what are the primary variables that play into the profitability of a Bitcoin mining investment? And I really want to approach this entire conversation today from the position of a pleb, not from institutional company Bitcoin miner, if you will. I want
Yeah.
to be the solo guy who wants to get a few hosted mining machines up and running with you guys, and I want to figure out what that looks like before I go ahead and dive into it head first. So what are those variables at a high level?
Yeah. Thanks for having me on, Mitch. Happy to unpack all of this. And I think it would be helpful to start by briefly explaining what mining actually is. Now, this could be redundant for some of your audience, but I think it's important because it lays the foundation for how most people can practically mine. So Bitcoin mining is running the same algorithm as many times as possible, the SHA-256 algorithm. And a block, which is a batch of Bitcoin transactions, gets, quote, mined about every 10 minutes. And only one entity, one miner, one computer in the world can actually mine each Bitcoin block. And if you mine it, you get, at this time, 3.125 Bitcoin. Now, this introduces a significant variable of luck because it's basically you're trying to guess and check as many times as possible. And if you find the right number, if you find the needle in the haystack before everyone else, you make a fat bag. You make 3.125 Bitcoin. It's like 200 grand at the current price. So you could run a Bitcoin mining machine, or you could even, in theory, you could mine Bitcoin on your laptop, but the odds are going to be stacked against you tremendously, right? Because you're running this guess and check algorithm, but you're competing against data centers with, thousands of dedicated purpose-built machines that do the Bitcoin mining. And so you basically have a better chance playing, blackjack in Las Vegas or buying a lottery ticket versus actually mining a Bitcoin block. So the practical way people can mine Bitcoin is through what's called a mining pool, where you want to mine and I want to mine. And we agree, hey, if one of us hits a block, we're going to split the rewards. It increases our chance of finding mining a Bitcoin block and gives us a more consistent payout structure. And so pretty much everyone mines through a pool. If you're not mining through a pool, there's two reasons. One, you have a giant data center where you can consistently and reliably mine blocks. And then the second option would be you just want to play the lottery, right? You have one of these small solo miners at home that doesn't consume a lot of power, and you're basically, playing like a $3 scratch ticket every day. And you're like, hey, I might hit a Bitcoin block and get $200,000 worth of Bitcoin. For everyone else, you're going to mine with a pool, and you're going to need a hosting provider. So the mechanism to actually mine Bitcoin is you need a data center. There's basically different layers. You need land and cheap power, and then you need infrastructure. So you need transformers, shipping containers. You need racks to actually like put the units on. You need a bunch of different types of wires. And so all of this infrastructure, if you were to go out and start your own Bitcoin mining operation from scratch, this would need to be part of your calculus when you're deciding to make this investment. You have a trade-off because you can build your own data center and deploy additional capex into all of these things. So the land, brokering a power contract, the containers, the transformers. This stuff is not cheap, and it adds to the upfront cost. So what we're going to really be focusing primarily on in this conversation is the hosted mining model, where you don't buy all of that infrastructure. You don't manage the data center on a day-to-day basis, repairing machines, cleaning them off, making sure everything's running smoothly. You simply work with an existing data center provider or a service company like Blockware, and you only buy the machine. You buy just the ASIC, the Bitcoin miner, the server, and then we have all of the infrastructure in place. And so your CapEx is much lower in this model. Now, the trade-off is your power rate's going to be generally a little higher than if you were to go and build your own data center. But most people don't have the time, the capital, or the desire or the expertise to go out and build their own data center. So from a practical standpoint, hosted Bitcoin mining is how you can mine Bitcoin if you're the everyday person and you're not just trying to play the lottery. So hopefully that's helpful context. And now we can talk specifically about hosted Bitcoin mining. And another euphemism, I guess you could call it, is we like to refer to it as CapEx light mining, because your only CapEx is the hardware itself. And you're not paying for all that additional infrastructure. And mind you, most people I say they need to I said your power rate's going to be a little higher if you're, hosted mining versus building your own data center. But when you compare it to like just trying to mine at your house, even hosted mining has a much, much lower power rate, right? Blockware clients mine between 7 and 8 cents per kilowatt hour. For reference, the average residential rate in America is about 17 cents per kilowatt hour. So even if you wanted to mine at home with a pool, not solo mining, you're probably not going to be able to do it profitably unless you have maybe some additional solar panels or some source of low-cost power that you're able to generate yourself. So with all of that context, hosted mining, what does it actually look like? Well, there are a lot of dynamic variables at play that can determine how much you're actually going to, earn over the long term. And I'll start, we're not going to take it in this direction, but there are tax benefits. So it's worth noting. And you get 100% write-off on the hardware. You've talked about that with Arneil. So we won't elaborate here. If you want to hear about that, definitely go check out Mitch's podcast with Arneil. They break it down very succinctly. So we'll push that to the side. The dynamic variables at play, you've got the Bitcoin price, you have mining difficulty, you have halvings, you have transaction fees, you have your power rate, and then you have uptime of the machine, and then you have your holding strategy. And I want to talk about the holding strategy because this is actually very important. It's the most practical thing that people can actually control, because all of these other variables for all intents and purposes are not really in anybody's control. Nobody controls the Bitcoin price. Nobody controls mining difficulty. The halving is a known unstoppable quantity. We don't control how many transaction fees are on the network. You have some control over your power rate, like you can mine with Blockware instead of mining at home. But generally, power rates are like any price in a market. Nobody really controls them. It's a function of supply and demand. You can control what type of miner you use, so you could purchase newer, more efficient machines. So that's a variable in your control, and then you can control your holding strategy. And what that means is, are you selling the Bitcoin you mine to pay your power bill, or are you holding 100% of the Bitcoin you mine? Because that's obviously going to adjust your returns. The more Bitcoin you hold, the more exposure you have to Bitcoin's upside, which is where a lot of the returns come over the long term. Obviously, Bitcoin is volatile in the short and medium term, but historically, it's grown 20 to 30% per year. Mining is a great way to get exposure to that if you position yourself appropriately. So just for example's sake, these numbers are not like how it actually works, but for clean numbers, let's say you had 20 miners and your monthly power bill was, call it $4,000. I don't know if that's the exact power, what it would be, but for sake of an example, right now, Bitcoin's 80K. You're probably going to mine about $6,000 worth of Bitcoin. So on an operating basis, you're bringing in $6,000 and you have a power cost of $4,000. So there's a $2,000 spread there. Now, what you could do is sell 3/4 of the Bitcoin you mine, or 2/3 rather, and pay that power bill. And then you keep that little surplus of Bitcoin. And that's great. Bitcoin's probably going to go up over a long period of time. Now, alternatively, you could do what we at Blockware call the HODL strategy, or another way to think of it would be replacing your dollar cost average with mining. So instead of selling some Bitcoin to pay that $4,000 a month, pay that $4,000 out of pocket. And one way to frame it is if you were investing in an asset, any asset, it could be Bitcoin, it could be stocks, bonds, gold, chances are the best strategy is not buying it once and totally forgetting about it and never making another allocation, right? Would you agree with that? I mean, you're a full-time investor. You don't buy something once. You
Sure.
dollar cost average into quality assets.
Sure.
And so if you buy the Bitcoin miner and then every month you just sell off some of the proceeds to pay the power, you're only bringing capital out of your pocket once on the front end. And it would be the equivalent of going and smash buying Bitcoin and then never dollar cost averaging, never putting any more capital into the system. Versus if you buy the machine, that's like your upfront lump sum purchase, and then you pay the power out of pocket with, free cash flow from your job, or, dry powder you have set aside. That's the equivalent of making a big buy and then dollar cost averaging as you go. And the net result is you end up holding more Bitcoin. And so then your returns on the mining operation become a lot more tethered to the price of Bitcoin. Because in the example where you sell some proceeds to cover the power, well, right now Bitcoin's 80K. Do you want to sell Bitcoin at 80K? Like, I would want to be a net buyer here. Versus, let's
Sure.
say a year from now, if Bitcoin's back at all-time highs, that would be like, instead of $600 of or 6K of Bitcoin a month, that would be like $10,000 of Bitcoin a month, or 12,000. And so you would actually have to sell much less of the Bitcoin at that price to cover your operating expenses versus at the current prices. And so the strategy you want to take may vary on market conditions, which is why I think when you're mining, and I think one thing a lot of people get wrong when they do is they don't have dry powder set aside. You want to have dry powder to continuously pay your operating costs and dollar cost average, build that Bitcoin position, and not be forced to sell your Bitcoin mining proceeds, especially towards like the bottom of a bear market, which that's up for debate, but I think Bitcoin's on an upswing. But if you've been mining in, the past 5-6 months, you've had to sell a lot of your mining proceeds to cover your power bill. You're selling Bitcoin at dirt cheap prices where you really should have been a net accumulator. So I'll pause there and let me know if there's any threads you want to pull on. Otherwise, I can keep going.
Sure. Want to retire soon, but you're unsure how to manage Bitcoin volatility, avoid selling your stack, and generate income from your portfolio? Imagine heading into retirement knowing that no matter what Bitcoin does next, runs to new highs, drops 60%, or chops sideways for years, you're good. Your income is secure, your stack is intact, and you're not losing sleep over it. That's what Strong Wealth offers retiring Bitcoiners like you. Book a free discovery call today at strongwealth.net to find out what retirement can look like with the right plan supporting it. Go to strongwealth.net. Now back to the show. No, that makes perfect sense. And obviously, yeah, that is a big part of it. What do you do after you've actually mined the Bitcoin? What I want to understand more is when is the best time to actually buy Bitcoin miners over buying Bitcoin? So let's say, somebody has $100,000 they'd like to deploy. Maybe they got an inheritance or something. I don't know, but they've got $100,000 and they're considering, should I buy Bitcoin? Should I buy Bitcoin miners? Maybe, there's obviously other options, but we'll just keep it to these two for simplicity's sake. Obviously Bitcoin miners, you get the tax benefits, which, as you said, we've gone over another video. To the short and sweet answer is put in $100,000, you get $100,000 deduction. There are some hurdles you have to meet in order for that to happen. So obviously, that is a win for buying Bitcoin miners over just directly buying Bitcoin. That applies in, as of Trump really making that rule permanent, that's going to apply now indefinitely into the future. So that's not really, again, it is a consideration, but it's not like one over the other as far as timing goes. So is it a Bitcoin bear market when it's best to buy Bitcoin miners over Bitcoin, spot Bitcoin? Or is it, Bitcoin, peak maybe?
Yeah. again, I don't want to elaborate on the tax benefit, but that is a huge component to this. So if you're in a state like California or New York and your tax rate's 40%, the most applicable way to think about it, if you spend 100K on miners and you save 40,000 on taxes, your hurdle rate or the capex you need to recoup is $60,000 because you got a $40,000 tax rebate. I'll pause there on that. But mining versus buying Bitcoin, it's an age old question. Which should you do, right? And I want to start by not maybe necessarily pitting one against the other, because I do both. And I think a well balanced portfolio can have exposure and probably should have exposure to both. Just as maybe you want to have some Bitcoin, maybe you want some options on IBIT that are, long expiring, deep out of the money. Maybe you want some MSTR, some STRC, different types of Bitcoin exposed assets in a kind of a well balanced portfolio, I think makes sense. So I'll start with that point. And then secondly, mining, I guess I wouldn't say it's a problem with the question, but to me, I view the mining as a long-term Bitcoin accumulation play. So the end objective is kind of the same. And it's like, would it be ideal to start in a bull or bear market? It depends on your time horizon, right? If you think that this is a 12-month trade, you definitely want to start in a bear market. But if you're thinking this is I want to build a meaningful Bitcoin position over 4, 5, or 6 years, then your timing doesn't necessarily matter because you're probably going to see a bull market and a bear market. That being said, typically what you want as a Bitcoin miner is you want the Bitcoin price to increase faster than mining difficulty. Your revenue is a function of these two things. It is because you're earning Bitcoin. It's all Bitcoin denominated. Difficulty determines how much Bitcoin you mine, how many other miners are out there competing for the finite supply of Bitcoin. And then, of course, the Bitcoin price determines how much that's worth. And so these two functions are kind of moving against each other. You want price to go up and difficulty to go down, or price to go up and difficulty to stay the same, or price to go up and it's okay if difficulty goes up as long as it goes up at a slower rate than the Bitcoin price. So ideally, you want to enter the market at a time where Bitcoin is undervalued and the velocity at which the Bitcoin price can increase is much higher than our ability as a species to build incremental data center capacity, because that's the bottleneck for mining difficulty.
Mm.
And this will be a little context for the industry as a whole. Early on, early to mid 2010s, when Bitcoin was still niche, Bitcoin mining was a new thing, and Bitcoin's price was increasing exponentially, you got a ton of research and development into the ASIC chips, the chips that mine Bitcoin that run the SHA-256 algorithm. And because it was so new, they were making technological improvements very rapidly. Like every 6 months, a machine would come out that mines Bitcoin 10 times more efficiently. And so if you had the old machine that could only do, a few thousand permutations per second, and then a new machine comes out that does 1 million permutations per second, you are just not competing in this game of guess and check. No chance whatsoever. And then, 6 months later, it would go from 1 million to 10 million permutations per second. Now we're at about 200 to 300 trillion permutations per second. Now, what's really important is the energy efficiency. So how much energy input is required to do that, 270 trillion permutations per second. And that's how we measure the efficiency or the effectiveness of these units. And so right now, the most efficient Bitcoin miner on the market it has a watts per terahash of 13.5. That's the most efficient that is presently you can mine Bitcoin with. Now, there's one in the pipeline that's going to be closer to 10. Still hasn't come out yet. It's been delayed like almost a year at this point. Now, the previous model was 15 watts per terahash. So it was like a 10% increase in the efficiency of the machine. So what does that mean? It means all the data center capacity we have for mining now, all of the power that's being input, if we took out the old machines and put in the new ones, hash rate would go up like 10%. Difficulty would go up 10%, which Bitcoin's price can go up 10% overnight. And so you start to game theory this out. How can you get a significant increase in difficulty? because it's not necessarily coming at the machine level because the marginal gains are so small at this point, right? You could only, in theory, get to 1 watt per terahash. You have to have some energy input. So there's a ceiling that we're approaching. So the answer is you have to build more data centers. You have to literally, increase the power production with wind or hydro or solar, nuclear, oil and gas, coal. You need more power, and then you need more containers or warehouses and transformers and racks and all of the infrastructure that goes into Bitcoin mining. And that's a months, years, decades long process to build. For reference, the largest Bitcoin mining facility, the industry is growing, so this may be an outdated statistic, but last I checked, it is Riot Platforms Corsicana facility. It's about 2 gigawatts, I think. The last time I checked, it represents about 2% of the entire hash rate of the Bitcoin network. So of all the Bitcoin mining capacity out there, it represents about 2% last I checked. So you'd have to build the entire biggest facility again, and you'd get a 2% difficulty increase. And that's like, an hours long swing for the Bitcoin price. So this is a lot of context, but what it leads up to is if you think Bitcoin's price can increase faster than we can build new data centers, the profit margins of Bitcoin mining is going to increase. So you want to enter the market at a time where price is going to grow faster than the difficulty.
Makes sense. So it seems like on the surface, this could be right now a great time to buy Bitcoin miners over buying spot. When I think through the variables that you're talking about, and then the scenario that you're laying out here of price needs to run faster than the hash rate. I mean, it seems like a lot of these data centers are not being built for Bitcoin mining anymore. They're being built for AI. And so that's, and there's basically, I won't say there's a finite amount of power, but there's a finite amount of power, land, all the things that you're describing. There's, you can't print this stuff. It takes time to build and create. And so if that already the lead time on building those takes years to decades, and the resources that would go into building those have been diverted into a different industry, AI, away from Bitcoin mining, then it seems like based on that, just those two things alone, that maybe hash rate is not going to increase as much going forward as we would expect. And I guess that also another thing that you mentioned that could play into that is just the the improvement of Bitcoin mining machines. It sounds like basically, there was a big spike up in the efficiency to where, you may have bought a Bitcoin miner and then 6 months you're uncompetitive. You got to buy a new one, which that's no good. You want to be competitive for at least, if I had to guess, 3 to 5 years to make this really worth it. And so if the increases in technological advancement of the miners is slowing down, the building of the infrastructure is being diverted away, and then we are also in a Bitcoin bear market where, I don't know, the macro picture is really making it look like a print could be coming in second half of this year. I don't know. What are your thoughts? I mean,
Yeah, you nailed it. I would think you're the Bitcoin mining expert because you hit the nail on the head. That's exactly the dynamic at play. And I'll really press in on this AI point because it's very significant. And we're actually seeing the first bear market in difficulty, really in Bitcoin's history. In 2021, China banned Bitcoin mining. And for the summer, difficulty dropped like 30%, but it rebounded pretty quickly. They just packed up the machines, sent them elsewhere, to Russia, actually, the United States, a bunch of different places, just not in China. Packed up shop, rebuilt somewhere else. Within like 3 months, difficulty was back at new all-time highs. We're now 6 months in, and difficulty has not made a new all-time high since October, November of 2025. And there's two factors at play. One, of course, you had the Bitcoin price. Bitcoin price drops. It makes less sense to mine Bitcoin. People with older machines at higher power rates, they'll turn off because it becomes uneconomical. But really, the bigger headwind for difficulty is what you mentioned, which is the artificial intelligence industry. And this is surprisingly, if you understand the nature of mining difficulty, this is a good thing. Bitcoin mining losing data center market share to AI is great for Bitcoin miners because there's less competition. And more specifically, there's less competition from the deep pockets of the world. If you actually have the capital and the resources to go build a 2 gigawatt size facility, you're definitely going to do it and run AI servers now instead of Bitcoin mining servers. And an interesting fact is some of these new AI deals where these data center companies are getting paid to run these AI servers, the hosting rate they're offered to run these servers is now it's trending higher. It's currently, last I checked, north of like 25 cent per kilowatt hour. And that number might not mean anything on the surface to most people, but for perspective, what this means is even when Bitcoin was at 120K last year, you make more money on this AI server hosting spread than you did with Bitcoin at an all-time high. And you don't have the volatility of Bitcoin. And if you're a public company CFO who has to beat quarterly earnings, you're going to have a hard time explaining to your shareholders why you would run Bitcoin mining servers instead of AI hosting. It's just more money, consistent revenue, longer period of time. Now, there is more capex in the infrastructure. So, like, they're both data centers, but it's not entirely fungible. A lot of the AI servers are they're not the same, right? A Bitcoin miner is basically like a cube. An AI server can be this long kind of like, I don't know, disk type of thing. And oftentimes they're hydro or immersion cooled instead of air cooled. So the actual all of the pieces you need around it are not the same. And so there's a cost to like refurbishing your data center, but the base layer is the same. The base layer is powered for both. You want cheap power, as cheap as you can get it. It can be nuclear, it can be wind, it can be solar. And like you said, you can't print power overnight. And AI is soaking up all the demand for any excess power there is. And it's getting a bad rap in the media world. And this is going to turn into an AI podcast unless you stop me. But I think it's important to note that
Yeah.
the demand for power is a good thing for humanity generally. And
Yeah.
in the short term, maybe it's possible that some of these AI data centers increase residential electricity prices, but what it's doing on the incentive level is far more important. It's incentivizing the production of more power, which if you plot energy consumption alongside quantity of life in throughout human history, they're basically one-to-one correlated. The more energy we can produce, the longer we live, and typically a higher quality of life, right? Think about all of the things that make our lives high quality from a comfort standpoint. Electricity powers all of it. So refrigeration, air cooled, whatever. Like, we want power.
Yeah.
More power is good for humanity.
Yeah.
AI and Bitcoin mining incentivize the production of more power.
Mhm.
So also AI makes us more productive from an economic standpoint. I'm sure you can testify to this, in your line of work. It's supercharging the most effective human capital in the world. I think it's going to be
Yeah.
a problem for like the middle of the bell curve type of individuals that, kind of follow the rules,
Yeah.
a the A students are going to be on the short end of the stick with AI. It's like the B and C students who are like hardworking but don't want to follow the rules, don't want to, kind of walk the standard generic path, that are really going to thrive with an AI charged world. I know we kind of derailed there for a minute, but I think it's important to note because these industries are emerging, and there's a lot of, like, I would call it AI FUD out there, and I want to make sure it gets debunked.
Sure. Sure. No, I'm with you. But yeah, I mean, it does seem like on the surface there is this, to your point, it's like if you have cheap power, you're going to go, build an AI data center over a Bitcoin mining facility, and so
Yeah.
that really does put a headwind on hash rate increasing very quickly. The flip side of this, though, is something that I've been concerned about with Bitcoin mining profitability, and I'm curious to get your perspective. Obviously, the tax incentives are a good thing on an individual level. So, if I'm going to go ahead and buy Bitcoin miners, I get the deduction like we've already talked about. However, what this now leads to is the incentive for capital to flood into this type of industry because there
Hmm.
is, if you compare it to, okay, let me just lay out a few different options really quickly. If I'm sitting here and I'm like, well, I'd like to get a tax deduction And I really have two primary options. The legacy option, if you will, has always been real estate.
Mhm.
And that's been where people go to try to offset their income with depreciation. And there was the long-term rentals, but those don't really offset active income. There's too high of a hurdle rate to be able to actually qualify for that to offset my income. Now the short-term rentals came into play. I mean, for me, they really came onto the scene big 2020, 2021. And that loophole with those allowed people a lower barrier to entry to qualify for the tax deductions by owning a short-term rental over long-term. So money flooded into Airbnbs. Everybody's buying an Airbnb. And now that we have this same type of tax incentive on Bitcoin miners, meaning the bonus depreciation allows for 100% of the capital to be depreciated in year one, that obviously incentivizes capital to go into Bitcoin miners. So I don't know, is this a tailwind for hash rate that you are concerned about as far as the profitability of miners goes? Because we've seen this almost diminishing performance of Bitcoin price.
Mhm.
Whether or not that's going to continue to happen, we'll have to see. But if we have a diminishing performance, diminishing volatility of Bitcoin, we have a tailwind of the tax incentives making hash rate go up. Obviously, we just talked about the headwind of switching to AI. So I'm curious from your perspective, do you feel like that incentive is going to drive hash rate up substantially and potentially decrease the profitability of Bitcoin mining? Or is that not something that someone considering this should be worried about?
It's a great question. And it's what makes Bitcoin mining a bit of a double edged sword, right? The better it is, the more people want to do it, the worse it becomes because difficulty goes up. But that's where the the reflexivity I was speaking of earlier, how fast price can go up versus how fast difficulty can go up, that's where this comes into play. And because you're absolutely right. This is a net positive incentive to mine Bitcoin. It's brought in marginal demand. I mean, I'm on the front lines of this. We have got an entire new cohort of clientele since this tax law changed. People that otherwise really had little to no interest in Bitcoin itself. They're a high income earner who wants a tax deduction. And they also understand, well, BlackRock is into this, Fidelity's into this. It's, the top 10 largest asset in the world. I should probably have some exposure. This mining thing seems like the best way to do it because I can get the deduction, kind of two birds, one stone. So it's brought in,
Interesting. Interesting. So
yeah,
you're seeing people that don't already own Bitcoin start getting their feet wet with mining over buying spot?
yes. Now they might own a little Bitcoin, but it's not like they're a laser-eyed Bitcoiner with 8 Austrian economics books on their shelves, right? It's like
Fair enough.
it's a small part of their portfolio, but they want it to be a meaningful part, and so they see the
Yeah.
mining as the way to do that because they want the tax deduction. So it's certainly bringing incremental demand to the industry. That being said, the amount of incremental demand that is needed to actually move the needle on difficulty is absurd, and it comes down to the law of large numbers, right? If 10 plus 1 equals 11, that's a 10% increase. 100 plus 1 equals 101, that's a 1% increase. And so as the hash rate is now about 1,000 exahash, building another 2 gigawatt size facility is going to increase hash rate by 2%. So the amount of demand that would actually be required to make a meaningful, substantial increase in the hash rate is just absurd. And I don't necessarily think you get that unless Bitcoin's price, skyrockets past like $150,000, which is possible. And that's why you want to be, an early adopter, right? You want to be on the front end. And something that's interesting, and you've seen it historically, is the years with the most growth in hash rate. It's always the year after the Bitcoin bull market because people decide when Bitcoin's at an all-time high, oh, now I should start mining. And there's a lag there because you can't build a data center overnight. You can't print power. And so there's kind of this time, 6 to 12 month delay where you get the hash rate bull market after the Bitcoin bull market because all of the investments were made at the peak. But during the actual time where the price is ripping, hash rate just can't grow overnight. And I I've heard a fact before. I don't know if this holds true in 2026 because Bitcoin's been subpar performer, but like 50% of the gains come on just 10 trading days a year. And I think this is generally true for like the S&P 500 and other assets as well. A majority of the gains are made just on a small handful of days, which is why time in the market beats timing the market. And so that nature of how financial markets works in the favor of Bitcoin miners, because you don't know when those days are going to be, but when that happens, your revenue jumps, 30% overnight on a dollarized basis. The difficulty is not going to jump 30% overnight. That's just physically impossible at this level. So hopefully that answers your question.
No, it does. I mean, the gist of what I'm hearing from you is it's not an incremental driver enough to really move the needle in such a way that's going to, drastically offset the profitability of Bitcoin mining, assuming
Yeah.
Bitcoin price continues to do what Bitcoin price hopefully should do.
Yeah. And
uh, you
and
know,
I think another thing too, that really the more impactful function of the increase in demand is higher prices for the mining hardware. So what's more scarce is the actual like hosting capacity. If we imagine this trend continues and more data centers are tailored towards AI instead of Bitcoin mining, even if you wanted to mine Bitcoin, it might be pretty difficult to find a host that can take you on. So, if you wanted to deploy $10 million into Bitcoin mining servers, like, Blockware can help you out. But if you come at the height of a bull market and we've got, 100 people like that coming through the door, like there might not just simply not be enough space at the data centers to do that. So what's going to happen is kind of like a bidding war between the different people. That's going to cause upward pressure on the actual machine prices themselves. So I think that's kind of the likely outcome in this scenario you're envisioning.
Interesting. I suppose that AI could also be the, it is the headwind for hash rate, but it's the tailwind for Bitcoin price potentially.
Hmm. Hmm.
So honestly, AI is in your guys' industry, it might be a good buddy.
Yeah, it's a great buddy. And if you look at you probably follow this index, the WGMI, the WAGMI
Yeah.
index. So it used to be like the Bitcoin mining ETF. They all
Yeah.
started to pivot to AI. The WAGMI has outperformed Bitcoin itself tremendously over the last year and 2 years, I think.
Yeah. Yeah. No, I was in that ETF for a little bit, but very familiar with it. Yeah, so okay. Let's let's
If I may too, while we're on the AI, there's
yeah, go
one
ahead.
more function where it impacts the Bitcoin price or area, I should say. So not the price, but the Bitcoin mining industry.
Uh-huh.
And it's actually at the machine level as well. So miners, they're ASICs, it's application specific integrated circuit, which is a fancy word to say it does one thing and it mines Bitcoin. Now, ASIC chips have semiconductors in them, and it's the same semiconductors that go in an AI server. And there's only really two semiconductor manufacturers in the world. You have Samsung and then TSMC, the Taiwan Semiconductor Manufacturing Company. And they're only two companies. They can't just snap their finger overnight and make more semiconductors. And the line is out the door from the Googles, the Anthropics, the OpenAI to get the semiconductors for their AI servers, and NVIDIA and whatever. Like all of the AI companies are bidding, and the capacity is basically at max. And what happens is they say, "Hey, Bitcoin miners, the mining manufacturers, Bitmain, MicroBT, Canaan, you guys have been great customers, but like Google wants to pay us, 100x. Sorry, we're going to fill that order first." And this is why you actually haven't really seen a new Bitcoin miner hit the market since 2024. It keeps getting delayed because at the actual like semiconductor level, the manufacturers are getting delayed. And so like right now, Bitmain is supposed to launch the newest miner this quarter in June. It's supposed to start being shipped to the United States.
Hmm.
We'll see. Like the when they initially announced it, it was supposed to be in Q4 of last year. So we're like 6 months delayed now. And so that's just another headwind on difficulty that AI is creating.
Interesting. Interesting. Yeah, so I guess the nature or this nature between Bitcoin price and hash rate, is that what is represented by hash price? Is that what that refers to? Or can you describe just how that works?
Yeah, precisely that. So it takes
Uh,
all of the the variables that are out of our control, which is the price, the difficulty, then the block subsidy. So that right now 3.125 Bitcoin, and then the on-chain transaction fees. It blends them all into one clean metric that lets you look at the revenue side of the Bitcoin mining equation, because all four of these variables are dynamic and they impact it, and hash price just aggregates that all into one clean metric.
Interesting. So that brings in the block reward and the transaction fees.
Mhm.
Um, that's cool.
I would say there's
Yeah.
hash price is good. It's kind of like the bread and butter standard. It
Okay.
does fall short in one area, and it has to do with the different machines, right? Because if you had
Mm,
200 terahash in 2020, that's way more valuable then versus now. But hash price trends down over time because we increase the actual difficulty, the machines become more efficient. So comparing it across time, you're going to look and see, hash price has trended straight down. But also, if you are entering Bitcoin mining today, you're going to have more hash versus if you entered with the same capital size, 4 or 5 years ago. So I think, if you can adjust it for the actual energy efficiency of the unit and the capex of the machine, that gives you a little more, judgment on the
yeah.
conditions. But overall, like from a kind of an intermediate perspective, like hash price is a very, very good metric to look at.
Is there a metric that does factor that in or no?
Uh, I believe I don't know if you know Mitch Klee. He used to work at Foreman. He's not too active in the Bitcoin industry. He put together something like this a couple years ago, but I can't remember exactly what he called it. But I might have to
Okay.
take the ball on that now that we're talking about this out loud.
That's all right. I think it might be good to visualize what a hash price looks like over time. I know you described it as going down. Do you have an easy graph that you could pull up that we could
Yeah,
because
I'll pull it
if
up real quick.
so while you're doing that, I just want to kind of set the scene a little bit. We do run the numbers on the economics of Bitcoin mining for our clients, and it does seem like that hash price function is the biggest driver of profitability. If you adjust that, even just sometimes I don't know if you would say 1 cent is that the right way to say it? Like if it went from point oh 0.04 to like 0.05, is that 1 cent? Is that how you?
Yeah, so I've got it pulled up here on my screen now. The
Okay.
brains, they actually listed in dollars. So in
Okay.
terms of petahash, which is just like another order of magnitude, typically it's shown in terahash, because like if you buy an actual miner, it's measured in terahash. So this would be like the equivalent of having 100 miners. But it makes
Mm,
it makes the number on the back end a little higher, easier to say. So what you can see here is hash price. It's right now it's about 35 petahash per day, or you could say it's 3.6 cent per terahash per day. And it's trending up over the past 3 months. Well, what's happened over the past 3 months? I'm sure you can guess. Bitcoin price is up and mining difficulty is down. So it's a perfect environment for hash price to continue. Now, if we zoom out, here's the 1 year view, hash price is down. You had the big and it kind of resembles the Bitcoin price, right? If we
mm,
really zoom out, you can see, oh, here's the 2017 bull market. Here's the 2021 bull market. Here's the 2023 and 4 kind of like grind higher. Here's the halving. You can see where it sharply drops off from here to here. Um,
mm.
it's difficult to see in log scale. You can see it again here in 2020. There was the halving. On the 5 year view, you can see, yeah, very clearly overnight hash price drops in half. And that's a known quantity. Like the halving is not something you can avoid. And it's a great thing because it's what gives Bitcoin a finite supply. The
Yeah.
way to prepare for it as a miner is to get the most efficient machine you can and the lowest power rate you can. So there's two kind of like doomsday scenarios for a Bitcoin miner. It's the halving and it's a Bitcoin bear market. Now you can position yourself for both of these by doing what I just said, getting an efficient machine and getting a low power rate. The way I describe these types of scenarios is if you're camping with your friends and a bear comes and attacks your campsite, you don't have to outrun the bear. You have to outrun your slowest friend in the group. Because if you can outrun him, you're going to get away.
That's
And
right.
halvings and bear markets are the same way, because we have this function called the mining difficulty adjustment. If
Mhm.
I have a lower break-even price than you, and the Bitcoin price drops or the halving happens, you're going to become unprofitable before I do. If I got a more efficient machine and a lower power rate, my economics are better. So even if my economics turn to crap because the block subsidy gets cut in half overnight,
Mm.
yours are going to be worse. And you're going to turn off your machine and difficulty is going to adjust down. And at some point, equilibrium is reached. And I mentioned before, like, this is really the first bear market in difficulty. You've seen like lulls and valleys. Typically after halvings and typically during bear markets, you get this equilibrium adjustment as the either over levered or inefficient miners have to capitulate. In the mining world, we call them hash ribbons. So when the 30-day moving average of hash rate drops below the 60-day, you can see hash rate is trending down. And typically this aligns with either a local bottom in the Bitcoin price or right after a halving. And there's an interesting dynamic when you think about how this actually works on the Bitcoin supply side. If you're an inefficient miner, let's say you're mining Bitcoin and your break even price is $75,000 per Bitcoin and Bitcoin's 77. You're selling almost all of the Bitcoin you mine to cover your power versus I have a lower power rate. My machine's newer, more efficient. Let's say my break even price is like 45 to 50,000 a Bitcoin. I'm still selling some Bitcoin to cover my OPEX, but not as much as you. And so when the price drops and you unplug your machine, that is sell pressure that is being removed from the network. So the miners who were selling the most amount of Bitcoin turn off their machines first, which kind of relieves some of the sell pressure on Bitcoin, of course, and that's good for the price over the medium term. And so typically, like one of the signs I look for when I'm thinking, hey, maybe there's a bottom here, are miners capitulating in mass? Are we seeing hash rates start to decline? Typically, it lines up with the Bitcoin price bottom. So hash price, great metric. It's kind of the bread and butter standard for measuring profitability. It drops off after halvings, of course. But as long as you position yourself in kind of the top 50th percentile of all Bitcoin miners, you're going to benefit from this dynamic where even when the market conditions turn sour, everyone else unplugs and difficulty adjusts down.
So, how do I like just looking at this right now? If I'm
Mhm.
someone that's considering Bitcoin, getting into Bitcoin mining, I mean, what does this mean? Because this is still like a different language to me. Just to be
Yeah.
honest, with you. So, like if I'm seeing this and I'm like, oh, that's a $56 per petahash or whatever you said. Okay, great. Is that good, bad? Like what is it? How does that translate?
Yeah. So it's all relative, right? It's bad compared to, 10 years ago when it was like you could buy Bitcoin for a few $1,000.
Yeah.
Um but compared to 3 months ago when Bitcoin was 60K and it was $29 per petahash, $30 per petahash, like a way to think about it, it bottomed around 30 uh and we're at 35 now. So that's like a 10% increase in overall revenue for Bitcoin miners over the past 3 months. Um, I think what we really haven't spoken about, and I think it's one of the more important variables in the equation, is simply what you pay for the machine, because that's your biggest expense is the
Mm,
actual miner. And the price of machines is fairly dynamic. And on the short term, it's impacted by the Bitcoin price. On the long term, it's impacted by, shinier, newer, more efficient machines hitting the market. Now, there's an interesting, like, basically the price of miners is up 30% since February. We were selling Antminer S21 XPs for like about $15 a terahash in February. Now Bitmain has them for sale at $17 per terahash. So the prices, that's going to cause ripple effects across the rest of the industry, because they kind of set the standard, right? They're the manufacturer, everyone buys from them. Oil and jet fuel prices are up, so shipping costs are up. So you can imagine, if the Bitcoin price is $100,000 later this year, like these machines could easily be trading in the $23 to $25 per terahash range. Now, that greatly affects your cost, risk benefit analysis if you're measuring, hey, do I want to start mining Bitcoin? you want to be able to pay as little for your hardware as possible. And like, 10-20% difference on the CapEx could be the difference between like breaking even long term or making a great return. So you want to time your entry appropriately, and you generally it's like you want to do this at somewhat of a scale, right? You want to buy at least 10 miners at once, because the more machines you buy, you're going to get economies of scale. Like, honestly, I wouldn't, for the retail pleb who's out there, he's like, I got, zero point 0.1 Bitcoin. Should I sell it and buy miners? I would say no. Like, don't do that. You're not going to get that many machines. You're not going to get the best pricing on the hardware. Um, and also, chances are that guy with zero point 0.1 Bitcoin probably doesn't have that high of an income. And so he's probably not being taxed at such a high rate. Mining, it makes the most sense for the high income earner that, can deploy at least like $50,000 to $100,000 into this without it being like his entire life savings. And also is being taxed at some, 30% plus rate. If that's like the profile of someone, I think mining makes sense. And you can get creative with how you purchase the hardware. You don't have to sell your Bitcoin. You could borrow against your Bitcoin. You could borrow against your equities, and let the asset continue to compound relative to the interest rate. Run a positive carry trade while also depreciating the machines and lowering your taxable income. So I think being strategic about how you actually purchase the units, doing it in bulk, getting the best pricing, and financing the purchase of the machines, I think that's the most appropriate way to start mining Bitcoin.
Gotcha. So, I mean, do you agree with my kind of feeling, I guess, maybe that now is a good time to buy Bitcoin miners? I mean, it seems like what you're saying is that hash price is trending down, but we still need to think of, okay, whenever it's bottoming and gonna go back up, which is a function of, based on what I'm learning here so far, it's a function of Bitcoin price going up faster than hash price. So if we are at, what we think could be a bottoming of Bitcoin price, and we expect it to not chop around for a year, we expect it to maybe, hopefully, get a run in the second half of this year. Assuming that all plays out, that I mean, it seems like that would make now a good time. Yes,
Yeah,
sir. Oh,
absolutely. And on that, machine prices are trending higher. So if you're listening to this and you think this makes sense, like, let me take some time to think about it, and you end up,
yeah.
waiting 3, 4, 5 months, if Bitcoin's back over, even 90K, 100K, Bitcoin's gone up, machine prices are going to follow suit in the short term, like they have recently. So like, now is the perfect time. I mean, technically, 3 months ago was the perfect time. And our
Mhm.
clients that bought when blood was in the streets, like any asset, you end up, looking like a genius in hindsight. But they were making those buys and they weren't sure, hey, maybe Bitcoin drops to 50K. Nobody knew. I think
Yeah.
I feel pretty confident that the 60K mark was the bottom for some of the macro reasons you alluded to.
Mhm.
Um, so yeah, now is a great time. Price seems to be trending higher. Difficulty has all these headwinds from AI. The macro picture certainly looks like they're going to start printing. If it's not the big print, it's like the gradual print. We're getting a new
Yeah.
Fed chair who I would imagine is probably going to play ball with what the administration wants. So a lot
Yeah.
of the factors are lining up for Bitcoin miners to do very well over the next 12 to 24 months. And the gravy on top of all those mashed potatoes, you get a major tax deduction on the hardware.
That's right. So I will say, I don't know. I have a feeling that we're going to have a temporary drop in Bitcoin price heading into the summer, and then off the back of that, it might be the crisis that they needed. But we'll see. That's not what the podcast is about, of course. So let's say that does play out, and let's just say Bitcoin does trend higher from here, or maybe over the next couple months is when we do see finally, the kind of bear market does finally shift as far as long term trends go. I mean, we stayed below the 200-day moving average, the last week or so when we tested 83K. And it rejected, and now we're back to 76. So I don't know. We'll see. But let's just say that these favorable conditions do end up playing out. What is the typical like break even time frame look like
Mhm.
for favorable conditions for mining? So, when we're thinking about the trade-off, like you're saying, of buying Bitcoin and buying Bitcoin miners, when do I actually become more profitable with miners in favorable conditions versus buying spot?
Yeah, great question. Um, Typically, and it comes back to what we started talking about the very beginning, which is that HODL strategy, right? Are you deploying incremental capital to cover your OpEx, or are you selling Bitcoin to cover your OpEx? Because that does change the dynamic. Because as one way to think about it, if you're dollar cost averaging Bitcoin by buying on an exchange and the price is going up, you're getting less Bitcoin. If you buy miners and your DCA is the power bill, it doesn't matter if the Bitcoin price goes up. All that matters is difficulty. And so Bitcoin's price can rip. You're
Mm.
still building a meaningful Bitcoin position consistently. And so in that environment where, let's take a 2-year time horizon, say like 2023, 2024, Bitcoin went up 100% each of those years. It was great to mine if you were doing the strategy, if you were deploying capital to basically DCA by mining. So like on the super like exuberant end where mining crushes, it's like a 2-year, kind of 1 to 2 year payback period before it beats buying Bitcoin directly. And then in the worst case scenario, it's like a 4 to 5 year payback period. And if I may, let's imagine this, what I'm thinking, which is the Bitcoin price is going to go up over the next 12 months. Let's imagine that actually isn't what plays out. Let's say we do get kind of a summer slump here. If you're doing this, if you're buying the machine up front and then you're deploying more capital to pay your power bill, this would actually, over the long term, be a good thing because the price coming down means difficulty will probably come down even more. You're still going to end up with more Bitcoin as long as you're solvent enough to continue paying the power bill and not having to dip into your mining rewards to do so. Short-term price, bear markets can be a good thing because they make difficulty come down. And if this is a 4-year play for you, difficulty coming down is going to be a great thing. You're going to end up with more Bitcoin.
Gotcha. Makes sense. What is the typical life cycle for a Bitcoin miner? So you're saying the payback period and favorable conditions can be 1 to 2 years, and in worst case scenarios can be 4 to 5 years. I mean, how long do I stay competitive enough before I just gotta get rid of the miners that I bought?
Yeah. It used to be 6 years. Now it's longer. The machines that were bought in 2020 and 2021, they're mostly unprofitable unless you're at like a 4 cent kilowatt power rate or less.
Mm.
So 4 years is kind of like the base case, but they seem to be trending longer. So I think you could reasonably expect 5 or 6 years out of the machines that are hitting the market today. But if you want to be conservative, plan for it to be obsolete in 4 years.
Got it. Okay. I from maybe my rudimentary understanding, I don't feel like this is a one-to-one comparison, but I'm curious to get your perspective on it because I know that you do have an understanding of financial markets and obviously a deep understanding of Bitcoin mining. So, in the right conditions, it feels like to me that Bitcoin mining could be similar to a call option on Bitcoin.
Hmm.
And the reason why I put it that way is because obviously the velocity of price movement upwards makes a call option worth more because people think that, oh, well, the price is going to continue to go up. And so they are willing to pay a premium for that call option. The other thing that seems like it's could fit is the strike price. The strike price is kind of like a break even in some ways. I mean, it's not again 1 to 1, compared to Bitcoin mining. Bitcoin mining price, where am I break even, and making sure that I am lower, if you will, than other people in the market. But then we also have the expiration. So the expiration of a call option, could be 6 months, 1 month, 2 years out, whatever. But the life cycle of the Bitcoin miner, you can kind of think of that as your expiration date. And so as long
Hmm.
as um, you need the price of Bitcoin basically to again outpace the hash rate within the time frame that you are mining, and you hope that you bought it basically right before the price does run is not
Yeah.
necessarily, but that's kind of like when it sounds like the best time, because then you're not getting this kind of like decay, if you will, of price just kind of chopping around. So I don't know. What do you think about that analogy? Do you feel like that works or
Yeah,
no?
I love it, and I actually wrote a Blockware newsletter
Mm,
breaking this down, each of those components of actually this time last year, May 2025.
no,
Um,
really?
yeah, and it was called like Bitcoin mining is a call option on Bitcoin. Because you have yeah, you have the premium, which is like the hardware price. You have
Yeah.
theta decay, which is
Uh,
difficulty kind of gradually rising, making your machine obsolete in the future. That's the
yeah.
theta, option expiration component. And then
Mm,
you have exposure to the Bitcoin price. And the most now, I don't use that framework now because we have the tax deduction. I'll come back to the framework I use now. But the
mm,
best way to see this exemplified is with old, outdated miners. You could think of them as an out of the money option. They're dirt cheap. You can go on Blockware's marketplace right now, which is a platform for buying used machines so our clients can buy and trade miners. You could buy a machine that came out in 2021. It's called the S21 XP. You could buy them for like $10. People have them. It's a free market. People can price them how they want. They're available for like $10 or $15, literally like almost free. It's basically a free Bitcoin miner you could buy.
mm,
And right now, last I checked, they're basically at break even. They might be losing like $5 a month. So you pay, 200 bucks a month in power to mine $195 worth of Bitcoin. But if Bitcoin goes up 20%, okay, you're not mining $195 worth of Bitcoin. You're mining like $220 worth of Bitcoin. And your entire capex was covered in 1 month because you had a $15 capex. And so it's like, it's kind of like an out of the money option that has a slightly negative carry. But if Bitcoin increases 100% over the next year, you could make all your money back like 3, 4, 5x. Um, Very like risk seeking, kind of degenerate because Bitcoin could go down and it becomes an even bigger negative carry trade.
yeah.
But that is one way you could express very short term bullishness is by buying these cheap, basically free older miners. And so
Interesting.
that your call option analysis is very applicable in that scenario.
Cool. I'm glad I'm tracking well.
Yeah.
So tell me the framework then that you're using now. If that is kind of an old framework, what's better?
I view mining, you could view it as like real estate. You buy an
Yeah.
Airbnb, it gives you a tax deduction and it generates cash flow. You buy a miner, which is the hard asset, gives you a tax deduction, generates cash flow. I tend to think of it as a tax advantaged Bitcoin annuity or a tax advantaged Bitcoin dividend, where
Mm,
what we've actually been really suggesting to clients, and maybe I'm breaking news here because we haven't done a direct full kind of go to market with this. We've been testing the waters with a few clients to see if this strategy makes sense for them, and everyone's loved it so far. And it's this: you prepay your electricity upfront because the electricity is a deductible business expense, so you can front load even more tax write off, and then you're not forced to sell Bitcoin at $80,000. It becomes revenue only mining, similar to if you pay the power out of pocket every month, except you're just going to pay it up front and you're going to get a slightly lower power rate for doing so. And then all of the monies you spend on day one on the hardware, on the power, fully tax deductible. You could pay up to 3 years of power in advance if you wanted to. And
mm,
then you're just getting this dividend. So, like an annuity, you basically give a bunch of money up front and then you get this kind of like drip dividend.
yeah.
Mining becomes that. So, you get this huge tax deduction on the front end. And then it doesn't really matter what the price of Bitcoin is, it matters what the difficulty is. So, you're going to get a little bit of Bitcoin every month for the next 3 years if you sign a 3-year hosting contract term. And the whole front end is tax deductible.
Interesting. Okay. I guess the it's kind of a blend of both of those analogies then, if you will. Um,
Yeah.
yeah. But I get where you're going with it. It, let's I feel like we maybe hit on the profitability and when it makes the most sense to do it. If someone wanted to run the numbers for themselves, do you guys have a calculator, or maybe you could just we have a fancy spreadsheet built out, but have maybe we could share that publicly. I don't know, but um where how could we find that, where can we run these numbers? And then 2, what are some reasonable assumptions, for a lot of these things? So I know you've mentioned, power cost with you guys is 7 to 8, cents per kilowatt hour, I think is how
Hmm.
you how
Yeah.
you, the unit on that. But yeah, let's run through the assumptions, and then maybe a resource where people could go to run some of the numbers for themselves, and not do it in a way where they're kind of like, producing fairy dust, like actual profitability metrics that they could expect.
That was a great question, Mitch. And we actually do have a spreadsheet breaking down the profitability. Now, everyone has their own reasonable assumptions on what the Bitcoin price will do, what uptime should be, what the hash rate is going to grow at. So the spreadsheet has dynamic inputs where people can play around with it. I'll send it over to you. You can put it in the description if anybody wants to go check it out. Um, but I think reasonably, I tend to be conservative, so I project that difficulty will rise going forward, despite all of the headwinds we talked about, which I think are very much at play. I think a reasonable assumption is for difficulty to grow 10 to 15% per year for the next kind of 3 to 4 years. Historically, it's grown around 30% per year, kind of between like 2020 and 2025. It was about a 30% per year growth rate. But we've got all this AI stuff going on. I think 10% a year is reasonable, and it could be negative. Where over the last 6 months, the difficulty is down. It could very much, 2026 could end, and throughout the year, difficulty went down start to finish. So, but if we want to be conservative, I would say 10 to 15%. Then for the Bitcoin price, everyone has their own expectations. I think a 20% CAGR is like very reasonable. If you're an extreme bull, maybe you think 30-40% CAGR. If you're more of a bear, maybe like a 5 to 10% CAGR. But 20% CAGR over the next 4 years is about a 165K per Bitcoin in 2030. I think that's reasonable. And so that's sort of my base case right now. But it's super dynamic, right? Because hardware prices change, difficulty changes, the Bitcoin price changes. So if you're listening to this podcast 3 or 4 months after it came out, your calculation is going to look a lot different than someone who listens to it day of. So the best way to get an up-to-date glimpse on what the forecast looks like is to speak with like myself directly and learn where machine prices are at and all of the other components, because it is quite dynamic. And so it takes like you want to talk to an expert, basically, is the short of it, because if you don't understand all of these different variables and dynamics, the calculator's not gonna make sense to you, right? Because I'm an expert in this, like I live and breathe it, and even sometimes like looking at the numbers, it can get a little complicated.
Yeah. Yeah, understandable. I mean, I'm in the same boat as you, really. As I kind of mentioned in the beginning, my business partner Jacob, he mines for himself and has built out the spreadsheet, but it feels like another language whenever he's trying to talk to me about it. And so I thought it might be good to have a conversation with you. I can get up to speed, but it also can be shared for the folks in the audience to um, learn as well. Do you feel like there's anything else that's important to note around Bitcoin mining, profitability? Again, someone that's sitting here, maybe they do have the favorable conditions that you described of high income, high tax rate, they're looking for a tax deduction, all that kind of stuff. Is there any other variables maybe that they should look out for, or worst case scenarios maybe, or just like they obviously, you work for a Bitcoin mining company, so they're naturally going to be like, oh, this guy's trying to sell me on Bitcoin miners. So I mean, is there anything that, pitfalls that you can kind of point them to say, hey, like, watch out for that, basically. As long as you miss that, you're good to go.
Yeah, great question. And the thing to look out for is who you're gonna trust. Because unless you want to build your own data center, which most people don't, you're going to have to work with a third party provider, someone like Blockware, to manage your machines for you. And on paper, we've got the spreadsheets, like Bitcoin price is probably going to go up. You can make all of this work on paper. The tax deduction is money in your account day one. Bitcoin tends to do what Bitcoin does. So like on paper, on the spreadsheets, a lot of this makes sense. But if you work with a bad partner and they mess up the operations, it doesn't work, of course, if your miners aren't online.
Mm.
And if something sounds too good to be true, it probably is. You could go online and search like hosted Bitcoin mining, and you hopefully you find Blockware on the first result. If you don't, there's companies out there that will say, hey, you know, I can give you 4 or 5 cent power, but the site's not in the United States. It's in Ethiopia or Uruguay or
Right.
Egypt or somewhere. And I've seen a lot of people get burned kind of going with the cheaper Kmart version of a mining service provider, because anybody can like find some cheap land, strike a deal with the power company, and put a shipping container there. Like there's a lot of what we call gypsies out there that will offer hosting, but it's not a top tier data center. It isn't someone who's survived multiple bear markets, multiple halvings, who's worked with all of the large public miners in the United States, family offices, and then mom and pops that have 5 machines. So I've seen people get burned trying to take shortcuts and go with the cheaper route, but it's outside of the US. Even
Mm.
within the US, there are some jurisdictions that are more favorable than others. The most important thing is to work with a trusted provider. So Blockware is the longest tenured mining as a service provider in the United States. I think our reputation speaks for itself. And on top of that, we have data centers that we work with all across the US. So in a variety of different states. So not all of our eggs are in one basket. And I think the important thing with mining is to mitigate risk. It's extremely risky if all of your infrastructure, all of your mining operations are domiciled in one state. Because all it takes is like one state level AOC who has it out for data centers to pass a law that's anti Bitcoin mining, and then you're SOL, right? Or the more tangible risk is a regional spike in power prices, because energy rates vary by different geographies. And so if you're all your eggs are in one basket, one grid, and something happens there, like you're not going to be able to offer a fixed rate, low cost power to the client. So we have data centers all across the US, a huge mix of different energy sources, different jurisdictions. So if something were to happen at one site in one state, we have flexibility. We can move the machine somewhere else and the client isn't hung out to dry. So I think that's really the most important pitfall to look out for, is who you're going to partner with if you decide to do this.
That's a good call out for sure. Yeah, I mean, we've heard stories about people outside of the country, with those great promises, low power. I won't say any specific companies, of course, but the customer service experience has been terrible, to say the least. And so, to your point, even just like a lead time to getting set up, is another thing. With the bigger providers, you probably have machines ready to go, to sell to your clients and plug them in today. Maybe, I don't know, but
Yeah, we do on our
uh,
marketplace. You can go there and they're online, and you could pay in
there you go.
Bitcoin as soon as your transaction confirms on chain. You're mining same day. Um, Also, I don't want to be the guy who's always doing a shameless plug. We did just take an investment from MicroBT, which is one of they're the second largest manufacturer in the mining industry. They actually manufacture some of their machines right here in the USA, even though
Huh.
they are a Chinese company. So that's going to shorten that lead time significantly because they're already on shore. So as we kind of migrate towards selling their hardware, that'll be something that's certainly a value add and de-risks the opportunity as a whole for our clients.
Interesting. Pretty cool. Awesome, man. Well, it's been a wonderful conversation. I feel like we covered a lot of what I wanted to. Yeah, I mean, feel free to. I know you don't want to be a shill, but feel free to share where they can find you, get connected, learn more, and maybe even start mining if they're interested.
Yeah, if you're interested, you can send me an email, mitchell@blockwaresolutions.com, or you can message me on X. That's probably like the best way to get in contact with me. So
Cool.
Mitchell Askew on X. You can also go to blockwaresolutions.com and walk straight through the front door. Any member of our team will be happy to help you out and show you what the economics look like whenever you're ready to make this decision. And even if you don't want to mine today, if you just want to learn more, be happy to talk as well.
Awesome. Thanks for your time, Mitch. Appreciate it.
Likewise.
Thanks for sticking around to the end. I greatly appreciate it. I'm Mitch, the founder of Strong Wealth, and we help Bitcoiners retire early and stay retired without sacrificing their peace. If that interests you, head over to strongwealth.net to learn more about us and our services. And don't forget to subscribe to the show. We really appreciate you watching all the way through. I'll see you in the next one.